Hey folks, welcome to a product review at Finominal. Today we're going to look at 4 of the largest multi-factor ETFs trading in the US stock market. And these are products from Invesco, Franklin Templeton, John Hancock and Goldman Sachs. Now all of these ETFs select stocks from the US large cap space based on factors like value, momentum, quality and low volatility. So let's investigate in terms of how these ETFs have performed and what kind of value they have created. The first thing that we're going to look at is in terms of how similar or different the underlying portfolios of those 4 ETFs are to the S&P 500. And over here we can see the kind of location of the underlying portfolios on metrics like valuation, market cap, growth, momentum, volatility and quality. And relative to the S&P 500, which is the red dot in the middle, we can see that all of those 4 ETFs are fairly similar and to each other, as well as the S&P 500. Now, stated differently, it means they're not very differentiated from a factor perspective, and we can investigate that by moving from a holdings-based factor exposure analysis to a returns-based factor exposure analysis. So here effectively you can see the betas to asset classes and to factors over the last 7 years. Now what we do see is that actually the factor exposures are surprisingly small. The only products are the one from Invesco, OMFL and John Hancock that have some betas. The product from Goldman Sachs, for example, there is no beta that we can measure, which is surprising given that if you look at the fact sheet of GSLC, you do see that stocks are selected on value, momentum, low volatility, quality. But oddly enough, we can't measure it. Now, that also explains that if you look at the risk sources of these smart beta ETFs, effectively almost everything can be explained by the stock market. And so the factors have contributed almost nothing. Now, that's from a factor perspective, and that's not great, frankly speaking, because you would simply expect like larger betas here and higher factor exposures from a multi-factor product. We can also look at, before we jump to performance, in terms of how these products have done from a risk perspective. And here we see the performance versus the S&P 500 during periods of market stress. And what we do see is, sure, in some periods, some of those products had a lower drawdown than the S&P 500, while in other periods they had higher ones. And overall, if we look at those 4 periods of market stress since 2016, there is no multi-factor ETF here that has consistently had lower drawdowns than the stock market. So from risk perspective, that's not that great. We can also look at those products from a performance perspective. And here it gets a little bit more interesting. So we do see that Invesco's product, OMFL, did actually outperform in the period from 2020, so this is like post-COVID, to around about mid-2024. Having said that, thereafter the product underperformed, and from today's perspective, so going back from 2018 to end of 2024, none of those 4 products have outperformed the S&P 500. Now, we've already looked at risk and saw that there was little differentiation to the S&P 500. Now we looked at return, and if you put risk and return together, you effectively end up with a Sharpe ratio. And what we do see is that although some products have a higher volatility, like the one from Invesco, OMFL, none of them had a higher Sharpe ratio than S&P 500. And that's kind of disappointing, and also kind of summarizes these 4 products that do manage substantial amount of assets. So for example, the product from Goldman manages more than $10 billion. But as you can see from a risk and return perspective, it's almost identical to the S&P 500. And intuitively, you could explain perhaps this by high fees being charged, but that's not the case. The fees range between, I think, 9 basis points to 15 basis points, so they're fairly cheap, but they also don't offer much. And so we can partially contribute the lack of performance to the either low factor exposures or also the lack of factor returns, which of course is the other side of the equation. And if you take a step back, and we published research about that multi-factor investing in the US, in terms of the long-only context like these products do, has been largely a 0% game over the last 10 years. So it's to a degree you can fault these products for not offering high factor exposures, especially the product from Goldman Sachs that is just an index hugger. But it's also a lack of factor performance. And that's also why we favor products that are dynamic in terms of factor exposures, like actually the product from OMFL aims to do, over static factor exposures. And that's simply a reflection of long-only factor investing not having performed well in the US stock market. In contrast, if you look at long-short factor investing in the stock market, and there are products like ones from AQR, QMNX for example, they are at record highs, i.e. having achieved substantial alpha. So that's something to think about, that from a market perspective overall, factor investing, at least in the long-only context in the US, has become less attractive, and that is what you see in the performance of these products. But also, of course, that when you look at multi-factor products, then you should select ones that offer high factor exposures, which these products do not. That summarizes our review of those 4 multi-factor ETFs. Hope that helps. Have a nice day.